All, I'm Lata Venkatesh, with me are Sunesh Shenoy and Anuj Singhal. Well, the global cues are looking very ugly. One thought that today will be entirely a domestically driven day with the monetary policy due in about 3 hours' time. But the global cues are so compelling that looks like the markets will have a lot on its mind when it opens, and there are no two guesses about which way it's going to open. Hi, both of you.
Hi Lata, good morning. Hi Anuj, good morning. Yes, if we didn't have the RBI policy today, we would be in for a very ugly start. Thankfully, we have that Q midday. At least for the first couple of hours, there could be, some holding of the bottom. But in terms of the global cues, Lata, these are important. I mean, not just the way the US markets stumbled, the Nasdaq falling about 3%, the Dow down more than 300 points, but also now this growth scare that we're seeing across countries and across asset classes. So yesterday it was China. Today we wake up to, the mining stocks in the European market stumbling quite a bit. Glencore is down 30%, and crude has also seen a big slide. We sort of preempted some of that yesterday when Europe was falling, but do you see more pressure today?
No, I think the markets didn't quite estimate the Chinese industrial profit numbers adequately.
Yeah.
We did see some jitters, but we were largely flat. It's only when Europe started discounting that through that sharp fall in Glencore shares by 30% that I think the global financial markets stood up and took notice that commodity prices are really falling because this big engine of growth is giving you, worse data. And 8.8% contraction in industrial profits in China ought have been better discounted even in Asia, and Europe correctly discounted that we are going to see even less demand coming in for industrial metals because China was the one that was consuming most of those metals. And that fall, we must remember, is coming at a very inopportune time. It is coming at a time when the Hillary Clinton tweet has already taken one big defensive category into red terrain, the biotechnology stocks. I mean, what do you do when cyclical stocks don't do well? You normally migrate to the defensives, but one defensive had already taken a huge knock because of Hillary Clinton, and another important cyclical, which has, one foot in consumption and one foot in cyclical. The auto stocks are taking a knock because of Volkswagen. So, there was really no place to hide, and that's exactly what took all those markets down. And the story just got repeated on the Nasdaq and on the S&P 500 as well. And yesterday, Nasdaq also, I believe, crossed the death cross, as they call it. 50-day moving average, moving below the 200-day moving average. Russell has already done it. The other indices are already wiping off all their gains for the year. So now really for the US it's a mix of both the growth scare as well as the potential of a rate hike. I mean, I think we have a little more to discount.
Oh yes, and we saw it in the numbers yesterday. There was selling of around 650 crores by FIIs in the cash market. And even in terms of individual stocks, there was quite a bit of delivery-based selling that we saw in large caps like, 200 crores in Tata Motors, L&T and Sun Pharma. So across the board, there was selling pressure that we saw. Also in Infosys, we saw 300 crores of delivery selling, 150 crores of delivery selling in Coal India. So a lot of these stocks came under pressure. But Lata, today, the big policy, we've gone through our poll several times that a lot of respondents expect a rate cut. But what about the commentary? Because that's what everyone's looking out for.
Yes, I think the rate cut is, like an also ran. Nobody is going to worry much about that. But the conversation is more likely to veer around whether the governor holds out any hope for rate cuts. Now, the phrase that gave us that hope, what made it a dovish pause in August was the phrase emerging opportunity for accommodation. This is a central banker's convoluted way of saying chances of more rate cuts. And that phrase was there. I will look for more opportunity to cut rates. That was the phrase that was there in the August policy. I'm not so sure to what extent that phrase will be there in the current policy. I think it will be absent. For one thing, because the Reserve Bank governor is no longer targeting Jan 2016 inflation at all. That number is now achieved. He was hoping to reach 6, and I'm sure he's going to say it's lowered now to 5.5 or 5.7. He's definitely going to lower it. But when you stand in October, you're going to aim for the next inflation target, which is 5% by Jan 2017. If you're aiming at 5% at Jan 2017, you jolly well know that 3.76 is largely because of a base effect. If you remove the base effect, this number, the last number we have is 5.5. You want to move from 5.5 to 5. It's unlikely that he's going to say, I'm going to give you rate cuts. I'm giving you today's. But going into the future, it will depend on how...
but is there a possibility, because of that similar theory, that perhaps today's rate cut could also not come through?
I'm pretty sure today's rate cut is there.
Okay.
I mean, ultimately anything can happen. Yeah. But I think an easy bet to win, and I'm ready to take that bet with you, is that today I think the rate cut will come. I think he said as much at Jackson Hole to Steve Leisman, saying that, you know, we have not done with rate cuts. And if you don't cut rates when inflation is 3.76, you're going to look very silly when you cut it when next month the reading comes at 4.5. The reading will come at 4.5 next month because of the base effect. So, I mean, what is the justification? If you don't cut now, why will you cut later? I think today is a given. But this chance of further rate cuts is what the market will want to hear. He may be constrained from not giving that commitment because he will say, I will be data dependent. If we show a tendency to move towards 5, then I will cut. But if we don't show that tendency, I will not. But my sense is that he will sound a little neutral rather than hawkish because of exactly what we just discussed, the manner in which global commodity prices are falling, the manner in which global growth is contracting. Not falling, it's almost contracting. I mean, if you look at the industrial profit numbers from China. So maybe that neutrality, since he's such a good observer of global trends, that will be there. The other two things that the market will watch out for will be SLR cuts. I think it's quite some time since he has announced. So a timetable on SLR cuts will be announced. I don't think the bond markets will be very jittery about it. Basically, it will mean banks don't have to buy so many bonds. But they are buying much more than they have to because they're a little scared of lending to industry. So I know that will be one expectation. The other big expectation is, will he raise the FII limit to be invested in government securities?
G-Secs,
yeah. He's not done that in a long time. The market is very, very keen. FIIs are very keen because this is the best credit they can ever get. I doubt he'll do that because at the moment he wants Indian currency to weaken. The manner in which other currencies are weakening, why would you invite more dollars in and strengthen your currency? So the market wants it, but I doubt it will come, and therefore my sense is bond markets could sell off because of the absence of an FII flow rather than anything in the policy itself.
Okay, so my question to both of you, and I'm going to come to Anuj first. Anuj, morning. Whichever way the ball rolls today from the RBI, is it a lose-lose situation from the market, given that we have this global overhang?
Morning, Sonia. I think we are barking up the wrong tree here. You know, this is a market which is in a bear market, in a cyclical bear market, and it will keep finding excuses. You'll remember 3 or 4 months back, I was discussing whether it's actually a 2008 kind of scenario, or maybe even worse. The answer was that in 2008 we had Lehman. What we have here right now, this Volkswagen issue is actually bigger than Lehman. You know, that was one company. This is impacting an entire sector. And a large part of the Europe fall yesterday was because of this Volkswagen issue, and which is now, impacting the auto sector throughout the world. So policy is a complete sideshow today, right now. The RBI governor may come out and cut rate by 25 basis points. If he actually doesn't cut rates, the market will not fall more. He cuts rate, the market falls more. He cuts rate by 50 basis points, the market falls even more. Because, then the market will believe that the last of the rate cut is actually out of the way. When would the global market have bottomed out? And again, I go back to the day after the Fed event. If the Fed had actually hiked rate, then the market would have fallen for next 2 days, but after that the market would have bottomed out. Now you have a sword hanging on the market. Now you have so many unknowns which are coming to the market and which is hitting global markets. So this is the fresh round of global sell-off that you're seeing across asset classes, and it would be foolish to assume that we'll be immune to that. We'll fall in line. The big question is, how much are we going to fall? Yesterday, FI sold 650 crores, and I think the volumes did pick up in late trade, Sonia. It was not a low volume day as we expected earlier. 14,000 crores, and even if you look at the gross volumes, there was quite a bit of pickup in gross volumes as well. So there was quite a bit of sell-off, and again, absorbed by DIIs. Otherwise, it would have been an even worse day. So today, 7,800 will go. Somehow the market has been defending that. 7,800 will go today, unless there's some miracle in the second half, which we don't know right now. Maybe in the language of the policy or anything, which may actually for a day or two maybe prevent this market from falling more. So that could happen. But for now, the big question is how much more for the market from here on. Yesterday, FIs played for a bit of a mini binary event. They bought both calls and puts. Puts at 7,500, calls at 8,000. Why 7,500? Because the last low for the market was 7,550, the last closing low, and intraday low slightly lower than that. So that really is the next big question. And again, I go back to the same question. 3 or 4 months back, everyone said that 7,900 was the double bottom for the market. Then we had 7,500. Everyone said 7,500 was a double bottom for this market. If you go there third time, make no mistake, if the market goes to support mark 3 times, it normally breaks it. So again, that will be important. 7550 support mark, whether that's broken or not. The key point is that from January, the Bank Nifty topped out in January, and it's October now. It's been 9 months. The Nifty topped out in March. It's been 7 months now. This is not a normal bull market correction. Normal bull market corrections are sharp, swift. They last for a month, 2 months, at best 3 months, and then the market moves on, which is a better scenario. This time correction that the market is taking for 9 months or 10 months, the market has not moved at all. In fact, has destroyed some portfolios. In fact, if you were to leave out 3 index stocks, which is Dr. Reddy's, Lupin and Maruti, I don't think anyone has made money in index stocks. People have made money in non-index stocks, but that really requires a lot of courage. That requires a lot of skill to pick out individual names and make money. And even in that, you can go horribly wrong in a name like Motherson Sumi. But otherwise, this has been a cyclical bear market, which has destroyed a lot of value. And my sense is that that's going to continue. Whenever people say that, the second half for the market is going to be better than the first half, anecdotally, the second half turns out to be even worse. So I won't be surprised if this market has to go back to 75.50. On the expiry day, the point we made was that if you have been surprised by or bothered by the volatility so far, brace yourself for the most volatile series in October. And you saw that with the start of the October series. The first day was so volatile, and volatility is going to be the only constant in this market. This is, again, not a market in which, you want to short at a 100-point or 200-point downtake. This is a market in which you want to wait. The market gives you shorting opportunity. You take that, and the market is seeking lower levels. This market will bottom out once Fed hikes rates at some point, maybe 1 or 2 months after or before that, as Shakti Shiva has also been pointing out. Till then, this is a market in which, taking unusually high risk is not going to give you any joy. The market is always respect the screen. That's the #1 rule in market. Respect the screen. Screen is telling you something is wrong with global markets and something is wrong with Indian market right now.
Yeah, I just wanted to add to a couple of things that you said. In the first place, why is the Fed not hiking? Because it is seeing a global economy that is contracting. So ultimately, that growth conundrum has to be resolved. And your comparison with 2008, I would still think that, the comparison with Volkswagen is a little, skewed only because Lehman is a financial entity. And so there is a domino effect. In Volkswagen's case, it's more, it's not something that the financial system will collapse. So there was this collapse feeling, which kind of colored the growth feeling. But otherwise, I take your comparison completely. There was a hopelessness about growth in the period from September 2008 to March 2009. And the worst of it was actually March 2009, when people almost thought it was depression times. But at that time, the hope still was that emerging markets are doing reasonably well, and this is a developed market problem. Now even that hope is not there. It looks like the emerging market piece is bad, and this developed market piece is barely crawling, which is why the rate hike is, something the Fed doesn't want to go ahead with, because it's not even quite sure of its own growth numbers. So while depression is completely a wrong word to use, in terms of comparison of the hopelessness about growth, I think the two scenarios do bear comparison. In both cases, there is no faith, and at least at that time, you got into the faith that central bankers will somehow pull you out. Now the feeling is that these central bankers are just, pulling wool over our eyes. They're not really able to fix anything.
The only way I think it could be different than 2008, and this is my personal view, is it worse than 2008? Honestly, I mean, forget about it being, same level at 2008. The thing that worries me is it even worse than 2008?
No, I think it's a bit too pessimistic. We have to get along with, okay, what do we have today, Sonia?
Okay, well, we are prisoners to global cues, so we can't deny that. So that's going to be top of our mind. But apart from that, we have lots happening on the show. But before that, I think we should get you some highlights of what took place in the US markets. It was a very disappointing day. 300 points gone on the Dow. And more importantly, the European market should come up for you. Over there was a big crack of 3%. A lot of these mining companies like Glencore and Anglo American fell fell substantially on the back of one report that came out where an investment brokerage suggested that the absence of substantial restructuring, nearly all the equity value of these mining companies could be deteriorated because of the way the global demand scenario is panning out. So that was the big takeaway from what we got in the European market.